I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. This is the Mortgage Brothers podcast show, and this is our interest rate update for February 8th.
That's right. And it's matching shirt day.
We showed up to the office. We're like, hey, interest rate recording today. And we're looking at our shirts going, oh, boy, we have the same. I mean, this is...
That's right. Hey, great minds think alike. That's all I can say.
All right. This is for informational purposes only. This is not financial advice. Let's go right into where we're at today. Inflation numbers. So again, we're going to talk about interest rates. And interest rates, of course, are directly affected by inflation right now more than ever.
What the feds have been doing for the past 9 months has been trying to battle this inflation creature. And just when you think, it's looking, good, something rears its head, but they continue to stay on that course.
So next week, Tuesday, February 14th at 6:30 Arizona time, that's when the new inflation numbers are going to come up.
Excuse me, that early? Wow.
Yeah, so it's early in the morning. So right when we're coming into work, it's out.
Okay.
And what will happen is the expectations are about 6.3%. Last month, the inflation number came out at 6.5. And remember, these are year over year.
You're right. Year over year, taking the previous month and then comparing that to a year ago, same month.
So January of 2023, looking back over to January 2022, what have prices done?
Right. And what the feds want is they want that number to be 2. I mean, look at the difference between 2 and 6.
Right. There's a long way to go.
Yeah.
And it's going to be an interesting how it plays out because interest rates and inflation, this is what's going to happen. If you want low interest rates, you want to see this inflation number come down. Because if we have inflation coming down, the Fed will then believe they're doing their job correctly and that they will not push the Fed rate any higher.
Right. Yeah. Picture inflation like a fire on your oven, and what the feds are doing with the interest rates is a fire extinguisher. They will put an extinguisher on this flame as long as they need to in order to put it fully out. If they don't, put it out enough, it could flare back up. And that's what they're talking. So they're going to continue on this path and then hopefully lay low for a while, not lowering rates, but just keeping it, in a holding pattern for long enough to know that it is out.
So I was in the supermarket 2 days ago buying groceries for the week for the kids. And I still am surprised of how much everything is. And even though I'd love to believe that inflation is getting under control, I keep on looking around going, I don't see it under control.
I do think that pricing does lag. I mean, it'd be interesting to talk to an expert as to how long does it take for that price of eggs and milk and bread to change. And it probably takes a little while as it comes down the conveyor belt and lands on that grocery shelf.
So that's what our hope is for a low inflation. All right. So this is the 10-year Treasury, the most important chart or instrument that traders are looking at. I mean, even though the 30-year fixed is, the reason why we're not talking about the 30-year fix in this chart is because the 30-year fix is affected by the 10-year Treasury.
Right. The 10-year Treasury is the parent, and the 30-year fix is basically the kid. The kid is looking at the parent saying, what are you doing?
That's right. So what will happen, what we're looking at here is going back, really until about June of 2022, we see that the 10-year Treasury hit a low around August 2022. The 30-year fix was like 4.99, 4.75, something like that. And we thought, okay, things are good. These are going to get better. But then rates, the 10-year Treasury started heading all the way up and hit a high about October 21st. And this is when the 30-year fix was just about 7%.
Right. And that's back when we were saying, bad news is good news. When there's bad news on the, market front, it's good news on the interest rate front. It's been very, very rare to say that. Yeah. And so it's been very tough. We've actually had some good news, which means it's bad news on the interest rate front.
So I want to point out a couple more things here. There were lows hit on the 10-year Treasury January 18th and February 2nd. If you were to lock at those days, you would have gotten really good, interest rates. Now today, the interest rates have gone up to
look at that
where we're at now. So that you can see, this is of course the 10 years. So the 10 years are about 3.67, but this is equivalent to where the 10-year Treasury was December 1st.
Right.
And November 15th, it was kind of hit down here, but yeah.
Yeah. And people could be saying, well, why is it going up when we're hearing about some of these big tech companies laying people off? Well, there's one key factor in there, and it's the unemployment number. The unemployment number remains to be super strong.
Which came out February 3rd. Okay, so it was last Friday. So February 2nd, rates were right here touching the bottom of where they have been lately. And then the job report came out showing about 500,000 new jobs came to the market, and they were only anticipating like 200,000 or so.
Yeah, and Jerome Powell even said that was totally unexpected, and he had just spoken the day before or a couple days before. So again, that's just tells you just how complicated this is.
So right now, all eyes are on next week for the inflation to see what that comes out. But right now, rates, let's look at where they're at today for actual mortgages.
Drum roll.
30-year fix, we see at 6.125. Last week, when we did that update, when rates were a bit better, we were seeing them at 5.7. The 15-year fix today is at 5.375. Last week was 4.99.
Yep, not as changed as the above rates. The 30-year FHA, 5.625, and the 30-year VA, 5.625.
And those quotes are based off of these factors for conventional FHA and VA. They come with no points. These are very standard scenario factors here. And remember, again, there's no extra fees. We're mortgage brokers, and we're in Arizona. We do all of our financing right now in Arizona, but it doesn't really matter what state you live in. If you're going to someone other than a mortgage broker, you're going to be paying higher fees. A mortgage broker is where you're going to get the best value.
Yeah, we shop a whole list of wholesale lenders, finding that best rate for you.
Yeah. And if you like what we're doing here, be sure to subscribe, comment if you have any questions. We're going to get back to any comments. If you have scenarios, it doesn't matter where you live, we're going to get right back to you, usually within an hour, even in the comments.
All right, unless we're having lunch.
Yeah, right. So we'll be back next week.
All right,
everybody.
Thank you, folks.
Thank you for watching the Mortgage Brothers podcast. If you have any questions, email us at team@azmortgagebrothers.com. And if you like this content, be sure to like, comment, and subscribe to the Mortgage Brothers team.